Thank you very much for joining me today, giving up your afternoon to talk about anti-dilution clauses and preference rights in capital raising. So if you've joined us on one of these sessions before, you know that this isn't legal or financial advice, and it's purely for educational informational purposes only. I started my first business when I was 5 years old, setting up a market stall in my cousin's garage and selling old toys to kids in the neighborhood. But being first generation immigrants, I of course was encouraged by my parents to go to university and get a degree. And I ended up studying law, partly because I enjoyed having a good argument. And partly because my dad had actually studied law when he was young, but because of the war in Vietnam, which is where I'm from, he never got to complete it. So for me, studying law was part of sort of completing that story for him. But the call of building something was always calling out to me. And I eventually started setting up my own business. And I've started and sold out of a number of businesses, including a tech startup. I've been advising startups for almost 20 years and have helped startups raise over $300 million. I've worked in big law, I've worked in-house for corporates, I've worked in Australia, New Zealand, Europe and Asia. But I had an experience back in 2012 when I came back to Australia from overseas, where I was helping a friend with his marketing startup, not in an official legal capacity. And he was working with a mid-sized law firm, a very well-known one in Australia, and they were negotiating a commercial contract. The lawyers had gone back and forth with each other almost 20 times on this contract. And I was getting frustrated because obviously this was costing him a lot of money. I said to him, look, can I have a go at this? I'll pick up the phone and talk to the other side, because really it shouldn't be taking this long. And that's exactly what I did. I picked up the phone, had a conversation with my counterpart on the other side, and we closed the deal. It was that easy. And that's when it occurred to me that I could help make more of an impact for startups by providing a boutique service where I can get involved in making sure deals get closed. So rather than being in a large firm where the incentive is always to delegate to a junior person where possible. And really that's how Metis Law was born. And Term Sheet Guru is our product designed specifically for early stage startups to help them raise capital quickly, cost effectively, and stress-free. I've been in the trenches of raising capital myself as a founder and as an advisor. So this topic of anti-dilutions and preference rights is one that I know founders don't understand very well, but it can have huge impacts on future rounds of capital raising and can certainly have huge impacts on the value that the founder gets out of the business when there is an exit. Not just founders, but also other early investors as well. So it's an important topic to understand. So you're doing great by being here and educating yourself today. There's quite a lot to go through today, and this is the agenda. At the end, we'll have a quiz, and we'll be giving away one ticket to our term sheet negotiation masterclass at the end of this year, where you'll learn negotiation skills focused around a term sheet for a capital raise. And you'll walk away with an investor-ready term sheet for your next cap raise. So if you want to be in the running for that, follow us on Facebook. Tony's going to put up the link in the chat. So just pop on there, follow us, and we'll run the quiz on there towards the end. Before we get started, I'd like to find out a little bit more about you so I can make sure that we customize today's talk to your particular circumstances. Tony's going to put up a poll to ask you a few questions. The first one is, which one best describes you? Are you a founder, a non-founder, member of a startup, an advisor, or something else? And the second question is, what stage of business are you at? You haven't launched yet. You've launched and you're in the startup phase with no or some revenue. You're looking for an exit in the next 12 to 24 months or something else. Now, you might actually tick more than one of those, but the one that most applies. And thirdly, where are you in your capital raising journey? Are you planning to raise? Are you in the process of raising? Are you advising on a capital raise or something else? So you quickly answer those questions so we get an idea of who we have in the audience today. Okay, fantastic. So we've got founders, you've launched a startup with no or some revenue, and you're planning to raise capital. Excellent. Perfect. Well, that's the perfect time to dive right into this topic. So we had a brilliant founder come to see us, and we like to call our founder Alex. This is a real individual whose name is actually not actually Alex, but we'll call her Alex. Alex has a startup that uses AI to predict cultural fit in teams in the healthcare sector. At the time, her startup had raised an angel round, and she had issued options to some early stage employees. So she came to see us because she was raising a second seed round, what we call a Series B, a Series Seed B rather. So she'd met an investor, Patricia, who was from a family office and was considering being the lead investor. Patricia had worked in the healthcare sector for over 20 years. She understands the issues in the industry and she's well connected. So Alex wanted to leverage Patricia's experience and her networks to expand the startup globally. And in return, of course, Patricia wants to ensure that her investment was protected. So she was asking for some preference rights. So just bear in mind that this is still a seed round. So a pre-Series A, it's still a seed round, although it would have been the second seed round that she was doing. Now, Alex wants to ensure that she doesn't disadvantage herself or her early investors or her employees, and particularly since she'd been working in the business for minimal pay for the last 3 years. So preference rights, as the name suggests, grants priorities and preferences to those investors who have those rights. This means that investors, founders, shareholders, any other investors on the cap table who don't have these preference rights are impacted. So this could result in those early investors getting less or sometimes nothing in return for their investment. If you've attended any of our workshops or webinars, you'll be familiar with this, which is the 3 pillars of capital raising. Each of these stages, if you complete them, will help you close a capital raise quickly and cost effectively. Now, I won't go into this in a lot of detail today, but we do go through it in our masterclass. But for context, what we're talking about today is part of the second pillar, Sprout, under creating your term sheet. So understanding these terms so that you can put together a term sheet to negotiate your cap raise. So the first preference right that Patricia requested was a cumulative dividend. So you may be familiar with the concept of a dividend. A dividend is a payment made by the company to shareholders if the company has made a profit in that particular year. So it's similar to an interest payment on a loan, and it can be paid in cash or in equity. In a term sheet for capital raising, it's usually expressed as a percentage of the amount invested by the investor. So what you'll find with early stage startups, however, is that usually the startup won't have enough profits available to pay out a dividend. Or even if they did, they would want to reinvest it in the business rather than paying out a dividend early on. Now, Patricia wanted a cumulative dividend because it means that if the company doesn't succeed, doesn't become a massive success, doesn't become a unicorn, then the dividend ensures that she gets some form of a return on her investment from those dividends. However, a cumulative dividend, one that she was asking, gives Patricia the right to not only receive dividends in priority to other shareholders who don't have that preference, but if the startup doesn't pay a dividend in a particular year, it actually accumulates each year. So by way of example, assume Patricia invests $2 million and gets an 8% dividend, cumulative dividend. So in year 1, if no dividend is paid, Patricia accrues 8% on that $2 million, which is $160,000. And non-preference shareholders don't receive anything at all. So she doesn't get paid that $160,000, but it does accrue. In year 2, again, the startup is just growing, so no dividend is paid. She accrues another $160,000, and so on and so forth. So that, say in year 4, a dividend is paid or there's an exit, then what Patricia actually receives from a dividend perspective is she gets the accrual of the prior year's dividends. So 160,000 times 3 for those 3 years actually gets paid. And then any funds left over to be distributed may then be distributed to ordinary shareholders. So it's a very good right for an investor to have, but it means that there's less left over for early backers who aren't preference shareholders, including the founders. The other type of dividend, which is a more founder and company friendly one, is a non-cumulative dividend, which is the opposite of a cumulative dividend, which means that if the board decides not to pay a dividend in a particular year, then the slate is wiped clean and the dividend is not accrued. So in our example, if no dividends paid in year one, then Patricia also gets 0. And she only gets paid her dividend if the company decides to pay that dividend. So you can see that it's less of an impact on early backers and founders because there will be more left over in the profits to share with non-preference shareholders. So if you were advising Alex, what would you, which approach would you take? Which would you say is more beneficial, cumulative or non-cumulative dividends? Drop it into the chat. Which one's more founder friendly? Cumulative or non-cumulative? Non-cumulative. That's right, Dave. It's an pretty straightforward non-cumulative. Make sure that the slate is wiped clean each year. If Alex's startup gets acquired or merged with another company or has to close down, this is referred to as a liquidation event. Now, this isn't to be confused with a liquidation generally, although a liquidation generally or a winding up is also a liquidation event. In the context of a capital raise, we often call a liquidation event or an exit event a situation where the startup gets acquired or merged or there's some sort of exit, even an IPO. So Patricia has asked for a liquidation preference. What this means is if a liquidation event occurs, she sits at the front of the queue when it comes to dividing up the proceeds from the liquidation event. So Patricia gets paid first and then everybody else shares in what's left over. This tends to be the second most negotiated term in the term sheet. And what you'll hear is people talking about a liquidation multiple. So a 1x multiple or a 1.5 times multiple. And what this means is if the startup gets acquired, is merged or merged with another company or has to close down, and Patricia has a 1x multiple, it means she gets 1x her total investment back first from the proceeds of the exit, then the remainder of the funds gets distributed between remaining shareholders. Now, if she had cumulative dividends and had accrued dividends as well, then she gets back her investment plus any accrued dividends. In this kind of environment, in the last few years, we haven't really seen multiples above 1x, which means that you really just pay the investor 1x their investment. You don't see 2x or 3x multiples in the current market. There are generally 3 main types of liquidation preferences. And the first is the participating preferred liquidation preference. Patricia wanted this right because it would give her 2 benefits over ordinary shareholders. Firstly, she would be first in line to receive her total investment amount of $2 million plus any accrued unpaid dividends. And she gets that priority payment over any ordinary shareholders, so anyone else who's not a preference shareholder. Then she also gets to participate or share in the balance of the proceeds on a pro rata basis. So this is what this looks like. So Patricia's investment is $2 million. The liquidation preference is a 1x multiple. She has participation rights. Now let's assume there's an exit, there's a liquidation event, and the proceeds from the liquidation event is $10 million. Patricia's investment gives her 20% equity in the company. So ordinary shareholders, including the founders, hold the remaining 80%. On a $10 million exit, the first $2 million goes to Patricia for her liquidation preference, her 1x liquidation preference. So that leaves us with $8 million. Now, of that $8 million, she gets to share in that at her 20% equity. That gives her 1.6 million on top of her 2 million. So she receives a total of 3.6 million. Alex, who holds 50% equity, receives $4 million from the remaining 8, and ordinary shareholders receive 30%, which is 2.4. So that's how the pie is split up, with a participating preferred liquidation preference. Now, we could counter Patricia's offer because it's quite, what she's asking for really puts her at the front of the queue and really reduces the pie for existing shareholders. So a more founder-friendly position is this one, called a non-participating preferred. This is where Patricia would be first in line to receive her $2 million, and her liquidation multiple is 1x. She doesn't participate, which means after the $10 million is distributed, $2 million to Patricia, the $8 million is shared amongst Alex and the other ordinary shareholders. So Patricia doesn't get to share in the $8 million balance. So what that looks like is this. Patricia receives $2 million in total. Alex receives $5 million. And the other shareholders receive $3 million. But as you can see, this isn't very attractive to Patricia, particularly if she doesn't have cumulative preference shares. I mean, most investors are investing in a startup and taking a risk in a startup to ensure that they can get really high returns on their investment. So for her to just get her $2 million back isn't a very good investment for her. But a non-participating preferred liquidation is really there to protect the investor if things don't go very well and the company has to close down and essentially not sell to anyone else. There is a middle ground, and this is the participating preferred option, but with a cap. So let's say, for example, we allow Patricia to have her 1x liquidation preference. We also allow her to participate with other ordinary shareholders. But we cap her participation so that the total sum that she gets back is no more than $3 million. So what would that look like? Patricia gets the first $2 million. There's an $8 million balance left over. Now, 20% of that $8 million would give Patricia $1.6 million. But because we're capping her at $3 million in total, the total she gets is $3 million. So there's $7 million left to share between Alex and other shareholders. So ordinary shareholders will get $2.625 million. And Alex gets $4.375 million. So you can see it's a middle ground position. Just compare the numbers for you there. So non-participating is the least attractive for the investor, but obviously the most attractive for the founders and early backers. The participating is at the other end of the spectrum, and the participating capped is sort of in the middle. So when you're negotiating these, if you have to accept a liquidation preference, then look at a participating preference, but cap it so that there's more left in the pot for early backers later on. We will have questions at the end, but feel free to drop them into the chat at any time as well. Now, Patricia wants to ensure that as the startup grows and new rounds of capital raising are undertaken, she doesn't get diluted, or her investment doesn't get diluted below the price that she paid for the shares. So she requests an anti-dilution clause. Now, this protects Patricia in future fundraising rounds, particularly where there's a down round. So where the company is valued at a valuation lower than the valuation that she paid when she invested in the company. Now, if you don't have an anti-dilution clause, What this means is all shareholders, including your early backers and Patricia, will share in the pain of any down round. I'll give you an example. So in this round, our Series Seed B, the price per share that Patricia pays is $2 per share, and she gets 40% equity in the business. Now, in the next seed round, there's a lower valuation. There's a down round. So the price per share paid by the new investor is $1 per share, and that investor ends up having 50% equity in the company. Now, Patricia, because she's invested last round at $2, isn't very happy about that. But if there's no anti-dilution clause, then all shareholders, Alex, the ordinary shareholders, and Patricia, get diluted. So Alex goes down to 25%, other shareholders go down to 5%, and Patricia gets her equity reduced to 20%. That's with no anti-dilution protection. You see, all current shareholders share the pain equally. There are two main types of anti-dilution clauses, and the one that Patricia asks for protects her to the maximum extent, and it's called a full ratchet. So a full ratchet anti-dilution clause operates so that the effective cost and equity for Patricia adjusts so that it's as though she invested her $2 million at the lower price per share of the Series Seed C round. So under a full ratchet anti-dilution, two things happens. First, the new investor gets their equity. So they get their 50%. And Patricia gets full ratchet protection. So she gets additional shares issued so that she maintains her 40%. So what does this mean for early backers who don't have this protection? It means that they take the full brunt of the dilution and the hit from the down round. So you can see here, the new investor gets their 50%, Patricia maintains her holding at 40%, and Alex and the other ordinary shareholders get diluted quite significantly. They take the full brunt. Now, there's a more balanced method of reducing the impact of a down round on investors, early investors and founders, and it's called the weighted average anti-dilution clause. And it operates around this formula here, which we use to calculate the new share price. But what it effectively does is two things. Firstly, everyone gets diluted. Alex and early investors do get diluted, but Patricia also gets diluted, but by not as much. So everyone shares in the dilution, but the extent to which they share in the dilution is based on this weighted average formula, so that if there are more shares issued pre the new round, the more shares you hold, the more of the weight of the impact of the dilution you bear. So we can see the comparison here. So the current round, Alex has 50%, ordinary shareholders start at 10, Patricia has 40. And you'll see under the weighted average, it sort of sits in the middle of no dilution clause and a full ratchet. So Alex gets diluted down to 20%. Other ordinary shareholders get diluted to 4%. Patricia gets diluted a little bit down to 20, and the new investor stays at 50. So it's sort of the middle of the road. Now that you are aware of what the different preference rights are, then we can start thinking about negotiating preference rights. And when we talk about negotiating preference rights, the starting point is understand the effect of each type of preference right and knowing which ones are most investor friendly and which ones are most founder friendly. And then create a situation where it's a win-win situation for everyone. Because as the founder, Alex wants money for her startup and Patricia does want to invest. So the starting point is always have in the back of your mind that you want a fair agreement. Don't bargain over positions, rather focus on interests. So a position is something that you decided on, whereas an interest is what caused you to make that decision. So an example of bargaining over a position could look like this in this particular situation. Patricia, the investor, says, it's market practice for investors at this stage to get preference rights. So we would expect to see the usual liquidity preferences, anti-dilution protections, and dividend rights. This is a really, really common approach by investors. They always say it's market practice. This happens, all investors get these rights. So that's bargaining based on a position. And the founder's position is, well, that's not fair, and it's our policy not to give out preference rights at this stage of fundraising. Then the usual response from an investor might be, well, if that's the case, we really can't participate in this round, although we really do love what you're doing and we think you as a leader could have some great success. But because neither party is willing to move, it becomes a battle of wills. And the parties get locked into their position the more they negotiate. So they're not really moving from their position. Whereas if we focus on interests and not positions, so the reason why you've taken that position, the reason that Alex doesn't want to give away preference rights until at least a Series A is because she's worked in the business for sweat equity for many years. She wants to ensure that early backers and employees are duly rewarded for taking on risk early on. Whereas from Patricia's perspective, her significant investment is going to help the startup move forward and scale. That's what she's saying in her mind. She also has investors. She runs a family office, so she has investors and a mandate that she reports to. So she needs to make sure that she protects her investment. So as you can see, you understand the reason why these two parties are taking the position that they're taking. So now that we understand that, how do we enable Patricia to satisfy her investment mandate, to protect her investment, while not unduly diluting early investors and backers too much to protect Alex's interest? So in the end, for Alex, what we ended up negotiating, because it was a seed round, we negotiated no preference dividends. We actually negotiated no liquidity preference, and we negotiated a weighted average anti-dilution clause. Now, we teach these negotiation skills in our masterclass, but it's based on focusing on positions and interests. That wraps up the main content part of today's webinar. I've been talking a lot about our masterclass. We will go into a lot more details around how you calculate the full ratchet and the weighted average, as well as looking at the different preference rights. We do that in our masterclass. We also teach you how to negotiate terms in your term sheet. So for 24 hours only, that's the special code anti-dilution gets you a ticket for $99. We don't offer this anywhere else, only to people who attend this seminar. And if you want a term sheet with that, it's anti-dilution TS for term sheet for $599. Do connect with me on termsheet.guru, our Facebook page, of course. I'm on TikTok, and we also have a podcast called The Raise, where we talk to founders about their capital raising journey. People like Brooke Roberts from Sharesies has been one of our guests. We've spoken to Mel Fife from Black Thumb recently. It's a really interesting podcast for anyone who is raising capital. So much gold in there about the journey and how to successfully raise capital from people who've actually done it. Before we go, thanks very much, Dave. You're welcome, Sonia. Any questions? Any questions about preference rights and anti-dilution clauses? It is a very complex topic, but a very important one. Still got people sticking around, so if you do have questions, pop them in the chat. Okay, I can't see any questions. So we'll wrap it up there. Thank you very much for your time today. I hope you enjoyed the session. If you did enjoy it, please say hello through one of our social media channels. Follow us. We have another topic next week. Thanks, Stephanie. We have another webinar next month. If there's any particular topic you'd like us to cover about capital raising, let us know on our Facebook page. Have a great rest of your afternoon.
Thanks, everyone.
Bye, everyone.